With more is Glenn Williams, Primerica CEO. Glenn, it's good to see you again. Welcome.
It's great to be back with you, Kelly.
Can you give us some context? Is 61% a big jump in terms of the people who can't pay off their bills each month?
Yeah, we really are seeing the stress of middle-income families as they continue to deal with the compounding effects of inflation. While it's true that inflation is slowing, we're still seeing, prices are up. They've not gone down. They're just going up more slowly. And when you have a multi-year compounding effect of that, maybe 3% this year on top of 7 or 8% last year, you've got middle-income families dealing with double-digit growth in prices. And there's just not enough money at the end of the month. And so what we see is they're bridging the gap with the use of their credit cards. We're seeing usage increase, balances increase, all at unfriendly interest rates. And so it's becoming a real challenge for these families.
To put it sort of weirdly or flip it around, I mean, I look at your share price and it's up considerably, 45% this year or something to that effect. Why is that?
Well, I think if you look in the long-term scheme of things, we have some periods where we underperform and some periods where we outperform like most stocks do. I don't think it's directly connected to the circumstances of today or the circumstances necessarily of the survey. We're in this for the long haul. We're a company that's been around almost 50 years. We've been public for 13. And we're just out there every day trying to meet the needs of a market that generally doesn't have access to all of the financial solutions maybe that the wealthy would have. And so that serves us well when we serve our clients well. Would
you say that you're a beneficiary of higher rates because of, I know you guys are in a couple different, life insurance businesses and those kinds of things, which we tend to think of as, hey, finally, I can get some yield on these extremely long-term holdings?
Sure, there is some benefit to our life company of the higher rates, but, the way we run our life business is fairly capital light. We're in the term insurance business, so we're not holding assets like most of the more traditional companies that have cash value products. So we don't get as much benefit from an increase in interest rates maybe as the average life company, but there is some tailwind there for us.
Yeah, so let's turn this back because, the flip side of this is some Americans are also benefiting, by the way, finally able to get some yield, but I don't think it's as many of these middle Americans as who are captured in your survey, and they're facing 20% credit card rates right now and things of that nature. What would you say this data most correlates with historically? What kinds of periods? I mean, is it as bad, are we back to pre-pandemic levels? Are we talking, something worse than that?
Yeah, as we monitored the middle income markets kind of attitudes, that's the reason we created the Financial Security Monitor was at the beginning of the pandemic was to try to make sure that we could stay in touch and really have our finger on the pulse of what middle income families were dealing with. We did see concerns as measured by the survey increase, obviously, during the pandemic. As the pandemic started to ease, people got a little more optimistic and had just a little breathing room. But now I think the cost of living has overwhelmed that. And while we find middle-income families are eternally optimistic, it's amazing just how positive they are in light of the financial challenges they face. We are seeing concern levels rising, and I think the longer we stay in this condition where the use of credit cards is bridging the gap between their incomes, which are increasing slightly, we'll acknowledge that, but they just haven't covered all the ground that was lost due to increasing cost of living. We're seeing those credit cards used, and we're very concerned that if interest rates remain high, those balances continue to compound. It's just going to put more stress on these families financially.
Yeah, and for an industry, the leisure and vacation industry that we see so much, excitement over right now, there's some concern expressed here. 43% you say plan to spend less on vacation and activities than they did last year. Only 14% expect to see more. A lot of people are looking for free attractions and that kind of thing. I also just want to mention, to your point about income, I mean, you've raised the income threshold for the survey. You normally would say, okay, middle income is 30 to 100K. Well, now middle income is 30 to 130K, and I thought that itself was an interesting development.
Yeah, as we monitor the survey and the types of responses we're getting, we recognize it's a moving target as household incomes move. And so we have expanded the range of the survey to make sure we weren't missing important data at kind of the upper end of the middle market. And we do see what you described. We see that non-essential purchases are the first things to go, as you would expect. I don't think there's anything surprising. And of course, vacations, travel, and that type of thing are on that list. What concerns us even more was the 72% that indicated they'd pause saving for the future. So that's where, It's a concern now, but it's a greater concern because they'll lose the compounding years that they'll need for their retirement. So, we are concerned about people not getting to take a vacation. That's always important for our mental health and probably our physical health. But financially, the bigger challenge is going to be those that are postponing saving for retirement and can't make up those lost years.
Glenn, thanks for bringing us these results. We appreciate it. It's good to check in with you.
Always great to be with you.